This is a summary of the book How to Make Money in Any Market by Jim Cramer. From homeless in his car fighting for survival, Jim Cramer clawed his way to millions by investing pennies at a time. Now he exposes Wall Street's lies to set you free. In How to Make Money in Any Market, he unleashes a battle plan against crashing economies and soaring prices, arming you with secrets to spot hero stocks in everyday chaos, turn fear into fortune. Blend safe funds with powerhouse picks that explode in value no matter the market's fury. Forget complex jargon. Grab his raw, no-nonsense steps to shatter poverty and seize your family's future. Break free from financial chains. The revolution starts now. Let's find out more.
It's quite the promise, isn't it? Break free from financial chains.
It's a huge promise, but I think when you really get into what he's saying, it's less about a magic formula and more about a mindset shift.
It's a total mindset shift. The whole mission of this book, the mission of our deep dive here, is really about democratizing wealth. It's about getting you to see yourself differently.
Exactly. It's about moving from just being a saver, where you put money in the bank and it, loses value to inflation, or worse, being a gambler.
Oh, we'll definitely get into the gambling part.
Yeah, and moving you into the role of a true investor. And that's a completely different identity.
It is, and he frames it as a kind of deprogramming. Because the thing he's fighting against is this narrative that comes from the financial industry, what he just calls Wall Street.
Right.
And that narrative is that investing is just too complicated. It's too hard for a normal person. You need us. You need to pay us our fees.
You should just settle for average. That's the phrase they love, right? Just put it in an index fund, get your average return, and don't ask any questions.
And don't worry your pretty little head about it. We'll handle it. They thrive on that ignorance, on that feeling of intimidation. It's their entire business model.
It's their job security.
Mm-hmm.
But before we get into the how-tos of his plan, we have to talk about the who. Because Cramer's credibility, I think, comes from a very, very real place. This is not some academic in an ivory tower.
Not at all. I mean, the backstory is it's pretty raw. He talks about hitting absolute rock bottom.
We're talking homeless.
Yeah, literally living out of his car. A Ford Fairmont, of all things. He had to keep a gun with him for safety because he was in a really rough part of LA and kept getting robbed.
And just think about that for a second. The mental state you must be in. You're living in your car, you're worried about your physical safety, you're trying to figure out where your next meal is coming from.
And yet, and this is the part that's just amazing, even then, in that moment of desperation, he was scraping together $50 a month.
$50?
$50 a month to mail to Fidelity, to put into the Magellan Fund.
Yeah.
It's an unbelievable display of faith in the future, even when his present was a nightmare.
It's either faith or just sheer desperation. A refusal to accept that this was his life now.
I think that's exactly what it was. And he says that refusal was shaped by this contrast he saw when he was growing up. He talks about two figures in his life. His dad, who he calls Pop, and this other man, a warehouse manager named Mr. Hank.
And this comparison it's everything. It's the core of the book, really. So Pop was a good guy, a hardworking salesman.
Yeah, but when it came to stocks, he was a gambler. He was always listening to tips, chasing the hot new thing without doing any real work.
And Cramer tells that story about National Video.
Oh, the National Video disaster. Yeah, Pop heard from a friend of a friend that it was the next blockbuster, the next big thing. He piled in.
And it went bankrupt.
Completely wiped out. Because Pop wasn't investing, he was playing a slot machine. He was treating the market like a casino.
Okay, so that's one path. Now contrast that with Mr. Hank.
Right. Mr. Hank was not a Wall Street guy. He was a retired Marine colonel who managed a warehouse full of paper plates and plastic straws. Not exactly a high-flying tech executive.
And yet
Mr. Hank became a millionaire. Quietly, no drama. He bought one stock, Merck, the pharmaceutical company.
Just one.
That's it. He just bought Merck stock consistently, month after month, year after year. And crucially, he reinvested all the dividends. He never sold. He just let it grow.
He treated it like a garden.
That's the analogy Cramer uses throughout the book. Mr. Hank was a gardener. He planted his seeds and let them grow. Pop was a tourist in a casino, pulling the lever and hoping for a jackpot.
And that really sets up the whole thesis of the book, which is that you need a two-engine approach to get this right.
Exactly. You need the safety of an index fund. That's your floor. That protects you.
Yeah.
But to actually get wealthy, to achieve that financial freedom, you need to find your own individual stocks. You need to find what he calls hero stocks.
Okay, let's unpack that. Because to even get to that point, you have to get over the biggest hurdle first.
Yeah.
Which is just the psychology of it all. Part 1 of our deep dives is really all about trust and fear.
It is the absolute biggest barrier to entry. Most people, when they look at a chart of the stock market, they just see a jagged line, a roller coaster.
Yeah, it goes up, it goes down, it looks terrifying. And the thinking is, well, it seems to just end up where it started, so why would I put myself through that stress?
Right. They see the volatility and they equate volatility with risk. And so they freeze. They do nothing.
Which is the roller coaster myth, right?
Yeah.
The idea that it's just a ride that goes nowhere.
Yeah.
But if you zoom out,
you see that the roller coaster is actually built on the side of a mountain that is constantly, relentlessly climbing higher.
I like that. So the ups and downs are there, but the whole structure is moving up.
Precisely. Let's put some numbers on it, because the historical context is really important here. Cramer points out that when he started law school back in 1982, the Dow Jones Industrial Average was under 1,000 points.
100,000.
Today, it's hovering around 40,000. That is a 40-fold increase, and that's not even counting dividends.
And the S&P 500.
A broader market, yeah. It's averaged something like a 10% annual return over the last 40 or 50 years. I mean, the numbers are just staggering when you really sit with them.
It means the ups have been exponentially more powerful than the downs. The mountain is much bigger than the dips in the roller coaster track.
It is, and you have to compare it to the alternative. What's the alternative? Sticking your money in a savings account, leaving it as cash.
Which just rots.
It rots. Inflation is a silent fire that just burns through your purchasing power every single day. Stocks are one of the only things historically that have provided a shield against that fire.
But people get so hung up on the crashes, the fear of the drop it's visceral. People remember the pain of 2008 far more vividly than they remember the gains of, 2013 or 2017.
Of course. Loss aversion is a powerful psychological bias, which brings us to a really, really critical concept he talks about, the paper loss.
This is what trips everybody up. You open your app, you look at your account, and you see the number is smaller than it was yesterday, and you panic. Your stomach drops.
It feels like you've been robbed. But here's the secret. You haven't actually lost a single penny until you sell.
Until you click that button.
Until you click that button, it is just a number on a screen. It's a paper loss. And Cramer goes deep into the history of the big crashes to prove this point. He looks at 1987.
Black Monday. The market dropped 22% in a single day. People thought it was the end of the financial world as we knew it.
They did. They were predicting another Great Depression, absolute panic in the streets. But what happened?
It came back.
It came back, and faster than anyone believed possible. The market fully recovered in less than a year. If you sold on Black Monday, you took a real, permanent, catastrophic loss. You locked it in.
But if you just held on.
If you held on, you were fine. And if you were brave enough to buy on Black Monday, you made an absolute fortune.
And we saw the exact same pattern in 2008 with the Great Recession and again in 2020 with the COVID crash.
The pattern is identical every single time. A period of extreme fear, panic selling from the public, and then a surprisingly swift recovery. Every single major crash in modern history has been, in retrospect, a generational buying opportunity.
The market rewards patience and just absolutely punishes panic.
Always. Which leads to his garden analogy, which I think is a really powerful way to reframe this.
I love this one.
He says to think of your portfolio stocks as a garden you're cultivating. You plant your seeds, your companies. Now, sometimes there are going to be big, scary rainstorms. Those are the recessions, the corrections, the crashes.
And what do you do in a rainstorm?
You don't run out into your garden with a shovel and start frantically digging up all your plants, right? That would be insane.
Oh, you'd kill them.
You'd kill them. The rain is not only inevitable, but it's actually necessary. It's good for the soil. It washes out the weak stuff and prepares the ground for future growth. You just let it rain.
Don't dig up your plants because it's raining. It's so simple, but so profound.
It really is. But, okay, even if you can get your head around that, there's another mental block that stops people. It's this deep-seated feeling of, I'm just not smart enough for this.
The too dumb narrative. I didn't go to business school. I'm not good at math. I don't work on Wall Street.
Which is music to Wall Street's ears. That is exactly what they want you to believe. If you feel dumb, you'll feel like you need them, and you'll happily pay their 1 or 2% management fee every year, which, by the way, devours your returns over time.
But Cramer's point is that the game has completely changed. That narrative is dead.
It's totally obsolete, and the primary reason is the revolution in technology, specifically AI.
He has a great name for it. Cramer GPT.
It's a funny name, but the point is so incredibly valid. He talks about how when he started, if you wanted to research a company, you had to physically go to a library.
And look at microfiche.
Yes, you had to scroll through these blurry microfiche slides to find a company's annual report. It was deliberately difficult. The information was hidden away.
There was a huge information asymmetry.
Yeah.
The pros had all the data, and you had nothing.
Now you have the sum total of human financial knowledge in your pocket. You can literally ask ChatGPT, summarize the key risks from Apple's latest 10K filing, or explain NVIDIA's competitive advantages in simple terms. You can get an answer in 5 seconds.
The gates have been thrown wide open.
They have. And it's not just the information, it's the access. He talks about commission-free trading. It used to cost $100 to make a trade.
And you had to buy in round lots, right? 100 shares at a time. If a stock was $100, you needed 10 grand just to get in the door.
Exactly. Now, commissions are zero. And with fractional shares, you can buy $5 worth of Amazon. You can buy $10 worth of NVIDIA. The financial barriers to entry have been completely demolished. There are no more excuses.
Okay, so the gates are open. The psychology is manageable. What's the actual strategy? This brings us to part 2, this big debate. Index funds versus individual stocks. Everyone and their brother says, just buy the S&P 500 and forget about it.
And look, that advice isn't terrible. It's fine, it's good, as Cramer would say.
But good is the enemy of great. Or in this case, good is the enemy of wealthy.
That's his point exactly. An index fund like the S&P 500 is just a basket. It's a collection of the 500 biggest companies. And in that basket, yeah, you have some amazing world-changing companies, but you also have a lot of mediocre ones.
And some real duds, too.
And some real duds that are on their way out. You're buying the good, the bad, and the ugly all lumped together.
So you're trapping yourself in average. It's the average trap.
It is. An index fund will almost certainly make you money over the long haul, but it won't make you rich in that life-changing, explosive way. It's a tool for wealth preservation and steady inflation-beating growth. It's not a tool for wealth generation.
And one of the things people don't realize about the S&P 500 is that it's not this static thing. The list of 500 companies changes all the time.
All the time. He calls it the S&P churn. Companies that stop performing, that start to shrink, they get kicked out, and new, more dynamic companies get added in.
It's a built-in survival of the fittest mechanism.
It is, which is why the index goes up over time. But if you only own the index, you are, by definition, always owning the companies that are about to get the boot. You're carrying that dead weight.
Whereas if you can identify the companies that are driving the growth, the ones that are the reason the index is going up,
then you can massively outperform that average. You can capture all of the upside without being dragged down by the mediocrity.
And this is where we get to what I think is the most mind-blowing part of the book, the chapter on the glory of individual stocks and this thing called the Bessembinder study.
It's a game changer. It's a piece of academic research from a professor named Hendrik Bessembinder, and it should change the way everyone thinks about the stock market.
So what did he find?
He looked at decades of stock market data, every stock that has ever traded, and he found something absolutely shocking. Most individual stocks are terrible investment.
Wait, most of them are terrible. That sounds like an argument for index funds.
It does on the surface, doesn't it? But stick with me. He found that the majority of stocks over their lifetime actually fail to outperform simple, risk-free treasury bonds. Many of them just lose money and go to zero.
So buying an individual stock is statistically a bad bet.
If you pick one at random, yes. But here's the flip side. This is the big reveal. All of the net wealth creation in the entire U.S. stock market over decades,
All of it,
can be attributed to a tiny, tiny fraction of stocks, roughly 4%.
Just 4% of companies are responsible for 100% of the gains.
That's what the data says. It's an insane statistic. A tiny handful of superstar companies generate such astronomical returns that they not only pay for all the losers, but they also pull the entire market average up with them.
So let me see if I get this. If you own the index, you own the 96% of losers in mediocre stocks, and you also own the 4% of massive winners. And the winners are so good that they drag the whole average up to that 10% return.
You've got it perfectly. The winners subsidize everything else. But just imagine if you could just own a few of those winners, just a handful of those hero stocks, as Cramer calls them.
Your returns wouldn't be 10%. They would be. I mean, you can't even calculate it.
They're astronomical. We're talking about companies like NVIDIA. Over the last 20-plus years, NVIDIA has returned something like 131,000%.
131,000.
Yes. If you have one of those in your portfolio, It doesn't matter if you have a few other picks that go to zero. The one winner pays for everything 1,000 times over. It's the power of asymmetry.
The most you can lose on a stock is 100%.
Right. It can only go to zero, but the upside is theoretically infinite. It can go up 10,000%, 100,000%. You just need to find one or two of those in your lifetime to completely change your family's financial future.
And the really encouraging part of this is that these aren't some, obscure biotech firms you've never heard of.
Not at all. That's the glory of individual stocks he talks about. The best performing stocks of the last 2 decades have been household names. They're the companies you interact with every single day. FANG, the Magnificent Seven.
Apple, Amazon, Google, Microsoft.
They were hiding in plain sight. You didn't need a supercomputer or an insider tip. You just needed to pay attention to the world around you.
Okay, so that's the big question then.
Yeah.
How do we find them? How do we identify the next hero before it's already gone up 1,000%? This moves us into part 3, finding your edge.
Edge. It's a word that gets thrown around a lot, and it's usually misunderstood. People think an edge is illegal insider information.
Right, like you get a tip from your cousin who works at the company.
Which will land you in jail. Or they think it's some incredibly complex algorithm that only a PhD in physics could understand. Cramer's definition is much, much simpler. He says an edge is just lawful observation.
Lawful observation, what does that actually mean?
It means using your own eyes, ears, and experience to notice something about a business before Wall Street does. He gives this fantastic example from his early days when he was managing money, a company called SPS.
Standard pressed steel.
Right. Not exactly a sexy company. It made industrial fasteners. But a friend of his who lived near one of their factories told him, hey, that place is humming. They're hiring everybody they can find. The parking lot is overflowing 24/7.
That's it. That was the edge.
That was the whole edge. He knew the business was booming before the official quarterly report came out and told the Wall Street analysts, so he bought the stock.
And it went up.
Of course it went up because the business was doing great. Now, contrast that with his orange juice story.
The negative example.
The perfect negative example. He bought orange juice futures. Why? His thesis was, well, people drink orange juice.
That's not an edge. That's a guess.
It's a total guess. It's a hunch. He had no special knowledge. He didn't know anything about weather patterns or crop yield. A sudden freeze came in Florida, wiped out the crop, and he got crushed.
So the rule is, if you can't state your edge in a simple sentence based on a real-world observation, you're not investing.
You are gambling, period. And this is where we have to make a very clear distinction between what he's advocating for and the whole meme stock phenomenon, GameStop, AMC.
Right, because on the surface, it looks similar. A bunch of regular people banding together.
And it's fundamentally different. What happened with GameStop was not investing. It was a coordinated mob action designed to create a short squeeze. It had nothing to do with the actual business of selling video games, which was, a declining business.
It was a purely technical market event, not a bet on the company's future success.
Exactly. And Cramer's warning is crystal clear on this. Do not ever confuse a Reddit thread with actual research. If a company isn't making money, if its fundamentals are deteriorating, then eventually gravity will win. The stock will go down.
Okay, so let's talk about the ultimate case study in lawful observation, the masterclass. NVIDIA. This is my favorite story in the entire book.
It's incredible, and it starts with him renaming his dog.
He renamed his dog from Everest to NVIDIA.
He did, because he was trying to get people's attention. The stock was trading for $4, split adjusted. Nobody on Wall Street cared about it. Yeah. He wanted to scream it from the rooftops.
But his edge, his reason for believing in it, wasn't just a whim. It was this incredible process of connecting dots that no one else was connecting.
It's like a detective story. Walk us through it.
Okay, so step 1. He's listening to a Best Buy conference call. Kind of boring stuff. But the CEO mentions offhandedly that these new things called netbooks are selling really well. So Cramer does the work. He asks, who makes the most important part of a netbook? It turns out the graphic chips were being made by NVIDIA. So dot number 1.
Okay, interesting, but not a whole story yet.
Right. Then step 2. He's interviewing an executive from Audi, the car company, and he asks what chips they use in their cars. Everyone assumed the answer was Intel.
Because Intel was the king. They were in everything.
But the Audi exec says, no, we use NVIDIA. They're much faster. And that was a shock. A car company choosing a graphics chip maker over Intel. That was a huge clue that something was changing.
That's dot number 2. The market is bigger than just computers.
Exactly. Then, step 3, he actually goes and visits NVIDIA's headquarters. And what he sees there blows his mind. He sees them working on simulations for self-driving cars, for artificial intelligence, for creating digital twins of entire factories.
And this is years before AI was a buzzword that everyone was talking about.
He saw the future. He saw that this wasn't just a company that made video game cards. This was a company that was building the engine for the next industrial revolution.
And that led him to step 4, which was his ultimate conclusion. Jensen Huang is Da Vinci.
He bet on the CEO.
He realized that the CEO, Jensen Huang, was a generational visionary. And he understood that the market was completely undervaluing not just the technology, but the leader behind the technology. That was the edge.
So the lesson is that you have to see the utility of the product, the application in the real world, before the numbers on the spreadsheet catch up.
Yes. Investing requires imagination. Wall Street is often looking in the rearview mirror at last quarter's results. You have to be looking at the windshield, trying to see where the world is going 5 or 10 years from now.
Okay. The philosophy is clear. The edge is defined. Now we need the nuts and bolts. How do we actually build the portfolio? This is part 4. Constructing the make money in any market plan.
He lays out a very specific, very simple structure, and it starts with a 50-50 split.
50-50.
50% of your investment money goes straight into a low-cost index fund. S&P 500, maybe the NASDAQ 100. That is your base. That's your safety net. It's your Mr. Hank Foundation.
It protects you from yourself,
Okay,
basically. If your individual stock picks are all terrible, you still have half your money growing with the market.
Exactly. Then the other 50% is for your active investments. This is where you hunt for those hero stocks.
And for that active 50%, he has a very specific rule, the rule of 5+1.
Right. Exactly. 5 individual stocks. No more, no less.
Why 5? Why not 3 or 10?
It's a sweet spot. He argues it's enough for diversification. If one of your 5 companies goes bankrupt, you lose 10% of your total portfolio, not 50%. It's a survivable hit.
But it's also a small enough number that you can actually keep up with them.
That's the key. You cannot effectively do the homework on 20 or 30 different companies. It's impossible for a regular person. But you can stay on top of 5. You can listen to 5 conference calls a quarter. You can read 5 annual reports. It's manageable.
Okay, so that's the 5. What's the 5+1?
The 5+1 is your hedge. It's your break glass in case of emergency asset. He suggests gold or crypto.
So something that's not correlated with the stock market.
Exactly. It's insurance. It's for the chaos scenarios, the hyperinflation, the wars, the moments when the traditional financial system feels like it's cracking. It's the small part of your portfolio that might do well when everything else is going down.
And where you put this money is just as important as what you put it in. He is a huge advocate for the Roth IRA.
It's the closest thing to a holy grail in investing. I mean, think about that NVIDIA example. If you bought it in a regular brokerage account and it goes up 100,000% and you decide to sell some,
the tax bill would be astronomical. It would be life-changingly painful.
You'd give a huge chunk of your winnings to the government. But in a Roth IRA, that growth, all of it, is 100% tax-free.
That is a massive, massive advantage. You are shielding your compounding machine from taxes.
It's the single biggest structural advantage an individual investor has. You have to use it.
He also mentions a tactical move for when the market gets scary, the pull-forward method.
Yeah, I love this. It goes back to the garden analogy. When it's raining, when the market is crashing, that's the best time to plant more seeds.
So let's say you invest $500 a month, like clockwork.
Right. And then 1 month, the market drops 20%. The pull-forward method says you try to find the money to invest next month's $500 right now. You pull your future contribution into the present to take advantage of the sale.
You accelerate your buying when things are cheap. It's simple, but it takes discipline.
It takes discipline and a strong stomach, but it's how you build real wealth over time.
But of course, you can't just buy any of the 5,000 stocks out there. He has a very strict process for narrowing the field.
He does. He says you can immediately eliminate 50% of the market. First, no penny stocks.
Why not? People love the idea of a stock that's 10 cents.
Because they're almost always scams or failing businesses on the brink of bankruptcy. The odds are just catastrophically against you. Second, no companies that are losing enormous amounts of money year after year.
With a few rare exceptions, like a young Amazon.
Very rare exceptions, but generally you want businesses that actually make a profit. And third, no companies with unethical or untrustworthy management. If the CEO has a history of shady dealings, run away.
And then he makes this really crucial distinction between cyclical stocks and secular growth stocks.
This is such an important concept for you to understand. Cyclical stocks are tied to the economic cycle. Think home builders, car companies, steel manufacturers.
When the economy is booming, they do great. When there's a recession, they get crushed.
Right. You're at the mercy of the broader economy. Secular growth stocks, on the other hand, are riding a long-term trend that's so powerful it happens almost regardless of the economy.
Like what?
Think about the shift to cloud computing. That's going to happen whether we're in a recession or not, or the aging of the population, which creates demand for new healthcare technologies, or artificial intelligence.
So you want to find companies with the wind at their back, a big, powerful, secular wind.
You got it. You don't want to be constantly guessing which way the economic winds are going to blow.
Okay, we've got our 5 candidates. They're secular growers with good management. Now comes the hard part for a lot of people. Valuation. Is this stock cheap or is it expensive? This is part 5, where we talk about valuation and the M.
This is where so many new investors get completely tripped up. They look at a stock's price. They see one stock is $10 and another is $500, and they automatically think the $10 stock is cheaper.
But the price tag itself is completely meaningless.
It is totally 100% irrelevant. A $10 stock could be wildly expensive, and a $500 stock could be an incredible bargain. The price tells you nothing without context.
The context is the price-to-earnings ratio, or the PE, which leads us to his core concept here, the M, the multiple.
Right, and he uses a great sports analogy to make this easy to understand. Think of a company's earnings as its performance, like how many points a basketball player scores. The multiple is what the market is willing to pay for each one of those points.
So a star player, a LeBron James, who is expected to score a lot of points for many years to come,
gets a huge contract, a very high multiple. People are willing to pay a premium for that proven high-growth performance. A bench warmer who barely scores
gets paid the league minimum, a low multiple.
Exactly. So a high-growth company like NVIDIA will have a high PE ratio, a high M. A slow-growth utility company will have a very low M. You're paying for growth.
But the real opportunity comes when you think the market has the multiple wrong.
That's the whole game. There are 2 ways to win big. 1, you find a great company when its M is unreasonably low because the market is scared or doesn't understand it yet. Or 2, you find a company where you know the earnings, the E, are about to explode upwards, which will force the stock price to catch up.
And he breaks down what moves a stock price on any given day into 3 buckets: macro, sector, and micro.
It's a useful hierarchy. He says 50% of a stock's daily movement is due to macro factors, things like inflation reports, Federal Reserve interest rate decisions, wars.
Stuff that's totally out of the company's control.
Totally. Then 25% is the sector. Is technology in favor right now, or is it energy? And then the final 25% is the micro, the company's own specific performance.
But, and this is the important part, he says that over the long term, the micro always wins.
It's the key to the whole thing. Over a week or a month, a great company can get dragged down by a bad macro environment, but over 5 or 10 years, if that company keeps innovating and growing its profits, its stock price will eventually break free and go up, regardless of what the Fed is doing. Performance trumps everything in the long run.
So specifically, what makes the stock go up? What is that performance?
It boils down to 2 things: earnings beats and multiple expansion. An earnings beat is simple. The company has to make more money than the Wall Street analysts were predicting. If the analysts expect $1 in profit and the company delivers $1.10, the stock usually goes up.
You have to consistently exceed expectations.
Yes, but the really explosive moves happen when you get the second thing, multiple expansion. This is when the market fundamentally changes its opinion about what kind of company it is.
Like his Walmart example.
The perfect example. For decades, Walmart was just seen as a boring brick-and-mortar discount store. It had a low M, like a bench warmer.
But then they started to get really good at e-commerce. They started competing with Amazon.
And suddenly the market woke up and said, wait a minute, this isn't just a store. This is a logistics and technology company. And the M expanded. The PC ratio went way up. The stock soared, not just because earnings grew, but because investors were willing to pay a much higher price for each dollar of those earnings.
To spot those moments, you really have to be paying attention. This is not a passive activity. Which brings us to our final section, part 6, doing the homework.
He calls it the buy-in homework ritual, not buy and hold. You can't just buy a stock and forget about it for 20 years. The world changes too fast.
And the first, and maybe most important piece of homework, is researching the management.
Absolutely. You are not just betting on a company. You are betting on the person running the company, the CEO. You're betting on the jockey, not just the horse.
He tells these great transformation stories. Larry Culp at GE is one of them.
A legendary CEO. GE was a mess. It was this giant, bloated, failing conglomerate that nobody understood. Larry Culp came in, and with surgical precision, he broke it up into 3 lean, focused, successful companies. He created billions of dollars of value out of what everyone thought was a lost cause.
And Tim Cook at Apple's another great one. When Steve Jobs died, so many people wrote Apple off. They said the magic was gone.
They said the visionary was gone and Apple was just going to become the next Sony. But Tim Cook, the operations guy, proved to be a different kind of genius. He transformed Apple from just a hardware company that lived or died by the next hit iPhone
to an ecosystem, a services powerhouse.
Exactly. The App Store, Apple Music, iCloud. He monetized the massive installed base of users. The market eventually figured this out, and the stock went to a whole other level.
He also mentions a little trick, the first 90 days rule.
Yeah, this is a great tell. When a new CEO takes over a company, watch the stock price for the first 3 months. Wall Street is very, very good at quickly figuring out if the new person is a superstar or a dud. The price action in those first 90 days is often very predictive.
Okay, so beyond judging the CEO, where do we go for the hard data, the actual numbers?
He says there are 2 sources of truth that you must use. The first is the company's own website, specifically the investor relations section. That's where they put all their presentations and press releases.
And the second, which sounds way more intimidating, is the SEC filings.
The 10K and the 10Q, the annual and quarterly reports. And I know when people hear SEC filing, their eyes just glaze over. They picture a 200-page document of dense legalese.
But you don't have to read the whole thing, right?
No, that's the secret. You just need to know what to look for. He says to focus on 3 things. First, cash flow. Is actual cash coming into the company's bank account, or are the profits just an accounting fiction?
Second, gross margins.
Right. For every $100 of stuff they sell, how much is left over after paying for the cost of that stuff? Is that margin getting wider or narrower? A widening margin is a sign of a very strong business.
And the third one, which is a great tell, is inventories.
The inventory number can save you from disaster. He uses the example of Caterpillar, the construction equipment company.
How does that work?
Caterpillar can report a fantastic quarter, great earnings, great revenue, and the stock will still crash. Why? Because if you look deep in the report and see that their inventory of unsold bulldozers has ballooned, that's a huge red flag.
It means they're not actually selling them to customers, they're just piling up in a parking lot.
Exactly. It means the next quarter is going to be terrible. The headline number looked good, but the inventory number told the real story.
Finally, after you've checked the numbers, there's one more piece of homework: listening to the conference call.
This is absolutely non-negotiable. It is the only time each quarter that management speaks directly about the future of the business. You have to listen.
But the key isn't the prepared remarks at the beginning, is it?
No, those are all vetted by lawyers and PR people. They're usually boring. The gold is in the second half, the Q&A session.
That's where the Wall Street analysts get to ask the tough questions.
And this is where you become a detective. You are listening for the tell. When an analyst asks a tough question about competition or margins, does the CEO have a crisp, confident, data-driven answer? Or do they hesitate? Do they get defensive? Do they change the subject?
The tone of voice is as important as the words.
It's more important. He uses that Amazon example. On one call, the headline numbers were kind of messy and confusing, but in the Q&A, a sharp analyst asked about the growth rate of AWS, their cloud business.
And the CEO clarified that its growth was actually accelerating.
And the stock just took off. That one little nugget of information from the Q&A was the most important signal of the whole report. If you didn't listen to the call, you missed it completely.
So let's try to tie all this together. What does it all mean for someone listening to this right now?
It means that building wealth isn't some secret code that only Wall Street insiders can crack. It's not about luck. It's about having a plan. It's intentional.
It's about structure. That 50-50 portfolio gives you a foundation.
It's about psychology learning to see market crashes as opportunities, not threats. And it's about doing the work, using your own observations to find great companies, and then verifying those observations with real research.
So the key takeaways: Trust the market's long-term upward trend. Remember the garden. Don't dig up the plants when it rains.
Use index funds as your safe floor, but understand that individual stocks are the ceiling. That's how you get rich.
And you have to do the homework. Observe the world around you, check the numbers in the reports, and listen to the conference calls.
And the most important takeaway of all is to start. Start now. Don't wait for the perfect time to invest because it will never come. Time in the market is infinitely more powerful than trying to time the market.
The biggest risk isn't a market crash. It's the risk of doing nothing and letting inflation eat you alive for the next 30 years.
Absolutely. The revolution starts now with that first $50, just like it did for Cramer in his Ford Fairmont.
That brings us to the end of our deep dive.
A fantastic journey.
Thank you for watching.
Yeah.
Please like it, share, subscribe, follow up in the next topic.
Come back to continue how to make money in any market.
It is great to be back. And, I'm excited because today we're finally putting all that theory into practice.
Right.
We've spent the last few deep dives on the philosophy, the why, and the how.
Yeah.
But today is all about the what.
The actual menu.
Exactly. We are diving straight into part 3 of Jim Cramer's book. And this is where, the rubber really meets the road. We're talking about hero stocks.
Hero stocks. It sounds like something out of a comic book, but I know the promise here is pretty serious. These are the specific sectors, the companies, the strategies he claims can build a millionaire-making portfolio.
That is the claim. It's about finding the companies that can, save your portfolio when everything else is going sideways.
But before we get everyone too excited, I want to be really clear about the mission here. This is not just us reading off a laundry list of ticker symbols for you to go buy.
Right, because if you just take a list of stocks without the logic, you're not investing, you're just copying. And copying, it stops working the minute the market shifts.
Or a CEO steps down or anything.
Exactly. So our mission is to unpack the logic. Why do these companies win? So you can apply that thinking for yourself.
Okay, so lay out the roadmap for us. How do we spot a hero?
We've got a packed agenda.
Yeah.
First, and this is the golden rule, we need to understand the difference between secular growth and cyclical stocks. Get that wrong, and nothing else matters.
Okay.
Then we're going to tour 10 winning sectors he called the safe bets.
Yeah, I know we have to address the elephant in the room.
The Magnificent Seven.
Okay.
Absolutely. We're going to ask, are they done? Are they too expensive? Then we'll look at some new IPOs, some income producers for safety, and finally the big one, the common mistakes that blow up portfolios.
All right, let's start with that foundation, secular growth. Now, usually when I hear secular, I'm thinking, non-religious. I have a feeling we're not talking theology.
You are correct. In finance, secular growth describes a trend that is just. It's long-term, it's powerful, and it is lasting. Think of it like a massive tailwind that just keeps pushing forward no matter what.
So if interest rates go up or GDP slows down, these companies almost have their own weather system.
Precisely. They grow rain or shine. And you have to contrast that with cyclical stocks.
Which are the opposite.
Right. Think raw materials, steel, paper, even auto manufacturers. These companies are completely tethered to the business cycle.
So when the economy's booming, they're great.
They make a fortune. But the moment the economy slows down, their earnings just fall off a cliff.
It sounds like a roller coaster.
It is. And the source is incredibly harsh on deep cyclicals, like steel and paper. He basically says, avoid them, unless your timing is absolutely perfect.
And let's be honest, whose timing is ever perfect?
Exactly. You're just gambling. The whole point of a hero stock is to find these one-way stocks you don't have to trade in and out of based on what the Fed did on a Tuesday.
I like the sound of that. A lot less stress. So let's get into the specifics. 10 winning sectors. First up, financials. But I'm guessing not just big banks like JP Morgan or Citi.
You're right. That's the twist. The source actually dislikes traditional banks for the average investor.
Oh, really? Why?
Regulation and risk. A bank is basically a black box. You never really know what's on their balance sheets until it's way too late. So instead, he pivots to financial tech and asset managers.
Okay, so not where you store your money, but the people who manage the money.
Exactly. An asset manager just takes a fee for investing your money. It's a much cleaner model. The prime pick here is BlackRock.
The giant.
The Leviathan. I mean, we are talking about the world's largest asset manager. They have something like $11.5 trillion under management.
That's bigger than the GDP of most countries.
Every country except the U.S. and China. They're the ultimate toll booth on the global economy.
Yep.
The other one is BNY. Used to be Bank of New York Mellon.
That's the one founded by Alexander Hamilton.
It's the very same. but they've completely reinvented themselves. They're not a corner bank. They handle tech services for the investment industry. Custody, clearing, it's a boring business.
But boring is beautiful in this context.
Boring is beautiful. It means predictable cash flow.
All right, let's move to retail. The source has a specific flavor he likes here, and it's not the mall.
No, malls are tricky. He loves the subscription model. The idea is that clubs beat standard retail, and the king of the club is Costco.
I love Costco. I go in for milk and leave with a kayak.
That's the treasure hunt aspect.
Yeah.
But from an investment view, think about how they actually make their money. It's not on the goods.
Right, the margins are razor thin.
Exactly. Their profit comes almost entirely from that membership fee, that $60 or $120 you pay every year. Pure profit. And it creates a recurring revenue stream.
It's like a software company, but for groceries. And the other one was TJX.
Yes, TJ Maxx, Marshalls, they dominate the off-price space. It has that same treasure hunt feel. Amazon can't really replicate it because the inventory is always changing. It creates urgency.
Okay, moving on to a sector that sounds a bit dry. Small business infrastructure.
This is the backbone of the economy. And the hero pick here is Cintas.
They do uniforms, right?
Uniforms, cleaning supplies, the mats by the door, fire safety checks. It sounds so mundane. But think about it. Over 1 million businesses need this stuff to operate.
So they're a bet on the economy just functioning.
Exactly. They find these unsexy niches and they just dominate them. Cintas is a classic moat. If they don't show up, the factory might have to shut down.
Okay, now this is where it gets really interesting for tech investors. The source brings up a specific tool for these high-growth companies that don't have profits yet.
Right, because if you look at a normal PE ratio, they look like disasters. You can't judge a teenager by the same standards as a retiree. So he uses the rule of 40.
I love a good rule of thumb. How does that math work?
It's a way to balance growth with discipline. You take the revenue growth rate as a percentage and you add it to the profit margin percentage. If that sum is 40 or higher, the company's healthy.
So a company growing at 50% can afford to lose 10% because 50 minus 10 is 40.
Exactly. It shows they're spending to grow, but efficiently. They're not just lighting cash on fire. And the example he gives is Palantir Technologies.
Okay.
High revenue growth plus a strong operating margin gave them a score of 68.2, way above 40.
That's a massive score.
It validates the growth. It gives you permission to buy a stock that might look expensive to a traditional investor.
That's a great tool. So what other notable sectors before we move on?
Aerospace is a big one. It's just simple supply and demand. Companies like Airbus and even Boeing, despite their troubles, have backlogs for years. You literally can't get a new plane.
And cybersecurity.
A huge secular trend. The pick is CrowdStrike because they're cloud native. They built their security for the cloud from day one. And finally, blockbuster drugs, specifically Eli Lilly.
The GLP-1 drugs for weight loss.
It's a phenomenon. The source sees this as a long-term shift in how we treat obesity, not just a fad.
Okay, let's tackle the giants. Chapter 19, the future of the Magnificent Seven. Apple, Microsoft, NVIDIA, Amazon, Meta, Alphabet, Tesla. Is the run over?
It is the trillion-dollar question, and the source's verdict is a very definitive no. He says they're too fantastic to be ignored.
But they're so expensive.
The argument is you get what you pay for. These companies have more cash than most governments, and they're constantly reinventing themselves.
Okay, let's break a few down. Start with Amazon.
He rates it an A. The key insight is to stop thinking of Amazon as just an online store. If you do, you'll worry about thin margins. Amazon is a logistics beast and, more importantly, a cloud giant with AWS.
Amazon Web Services.
Right. It powers a huge chunk of the internet. That's the profit engine that funds everything else. You're buying the infrastructure of the digital world.
What about Apple? People always say the iPhone is done, everyone has one.
And the source says that's missing the point. The real story isn't the hardware, it's the services. It's the installed base. You're talking about 2 billion active devices.
That's a lot of pockets.
And Apple owns a toll road to all 2 billion of them. They get a cut of everything sold in that ecosystem. It's a walled garden, and it's incredibly valuable.
Now, NVIDIA, the face of AI. But there are worries about energy costs, right?
That's the concern, yeah. AI data centers are power hogs. But the view here is a bit counterintuitive. NVIDIA's chips are actually the solution, not the problem.
How so?
Because they are so much more energy efficient than the older chips. If you want to run AI without melting the power grid, you need NVIDIA's newest chips. So energy constraints actually increase demand for them.
That's a fascinating angle. What about Meta?
Meta is interesting. People love to hate it, but the numbers are just undeniable. The source points out it has a surprisingly cheap PE multiple, given it has 3 billion monthly users.
3 billion? That's almost half the planet.
Is a cash machine, and advertisers have nowhere else to go for that kind of reach. It's often undervalued because of the brand noise.
And the wild card, Tesla.
Tesla is, well, it's Tesla. The source admits it really depends on Elon Musk's mood. It's unpredictable, but it's a real manufacturing company at a massive scale. You can't count them out.
So the Mag 7 aren't done yet, but what about new blood? Recent greats?
These are higher risk, but higher reward. A standout is ARM Holdings.
Now, they aren't technically new.
Correct. They just re-IPO'd.
Right.
But the key is their business model. They don't make chips. They design the architecture, the blueprints.
So they have none of the factory overhead.
Exactly. Their designs are in 99% of all smartphones. You can't make a modern phone without paying ARM a royalty. They're the architects, collecting royalties on everything.
Then there's Airbnb.
Despite all the complaints about chores and fees, the source calls it a winner. It has fundamentally changed travel, and it's finally profitable.
And Dutch Bros.
That's a classic retail expansion play. A coffee chain growing its store count like crazy. It's like buying Starbucks back in the 90s.
Okay, let's pivot. Because not everyone wants high-flying tech. Some people want income. They want to sleep at night.
Right. Chapter 18. The goal here is income with growth. And the source loves pipelines.
Sounds a little gritty.
It's gritty but lucrative. Think of them as energy toll roads. The pick here is Enbridge, a Canadian giant. They're a dividend aristocrat, raising their dividend for almost 30 years.
So you get paid, and you get a raise every year.
Exactly. And then there's real estate. We keep hearing commercial real estate is dead. Is it safe?
That's the question.
You have to be selective. The source like Simon Property Group, which owns the high-end A-class malls, those are actually thriving.
A flight to quality.
Exactly. And for a regular paycheck, there's realty income.
They call themselves the monthly dividend company.
They do. They pay every single month. And their tenants are places like 7-Eleven, Dollar General, recession-resisting businesses. It's not going to double overnight, but it won't keep you up at night either.
Okay, we've covered the heroes, we've covered the income. Now we have to talk about the mistakes we make. Chapter 20.
This is maybe the most important section because you can pick all the right stocks and still blow it all up with bad psychology.
And the first lesson is beware the headlines. The example given is Caterpillar.
It's a classic trap. You see a headline, Caterpillar beats earnings. You think, great, buy.
And then the stock tanks 5%.
And you're just sitting there confused. But if you had listened to the actual conference call, you'd have heard the CEO say, but our inventory is piling up on dealer lots.
The headline captures the past, but the stock moves on the future.
Precisely. You have to do the work. Dig deeper than the headline.
Lesson 2. Diversification is not an excuse.
This one hits home for a lot of people. You own a stock, it's tanking. The whole reason you bought it is broken, but you keep it.
Why?
You lie to yourself. You say, well, I need exposure to this sector for diversification. No. If a stock is a loser, sell it. Replace it with a winner. Don't hold bad companies.
Lesson 3. Billionaires won't save you.
We see them on TV all the time, the billionaires of doom, predicting the end of the world. The source says, stop listening to them.
That they're billionaires, should they know?
They know what's good for them. They might be shorting the market. Their agenda is not your agenda. They are not trying to help you retire.
And finally, lesson 4, the bond market.
Right. People see an inverted yield curve and scream, recession is coming, sell everything.
And it does come, eventually.
Eventually. But the bond market is often wrong, or at least way too early. The source calls it the sum of all fears. If you sold your stocks every time the bond market got scared in the last decade, you'd have missed one of the greatest bull runs in history.
So don't let the bond traders scare you out of good company.
Exactly. Focus on the company, not the macro fear.
So what does this all mean? We've covered a massive amount of ground.
If we pull back, the hero stock philosophy is pretty simple. You're looking for observable, understandable businesses with that secular growth trend behind them.
And it's about balance.
It's about balance. You have your growth engines like the Mag 7, and you anchor them with income producers like Enbridge to keep you steady.
But, and this is the final thought he wants to leave us with, don't let this list make you lazy.
The homework.
The homework. This is a starting point, not the finish line.
Right. The market is a living thing. A hero today can become a zero tomorrow. You still have to listen to the calls. You have to check the micro.
Yeah.
You have to stay engaged.
Which brings us to something to chew on. We talked about AI, but we also talked about how headlines can mislead us because they lack nuance.
That's the tension.
In a world where AI writes more and more of those headlines, that homework, listening to the actual human voices on the conference calls, hearing the hesitation in a CEO's voice, that might become the biggest edge a regular investor has.
There's a profound point. The human element of interpretation, reading between the lines, that is still your best asset. The machines can read the data, but they can't always read the room.
Thank you for watching. Please like, share, subscribe, follow up in next video.